I'm Josh Sheluk. I'm the Chief Investment Officer for Verecan Capital Management. The Chief Investment Officer's main responsibility is to be the ultimate decision maker for the investment process and philosophy and investment decisions that get made on behalf of our clients. Our investment philosophy is really rooted in the idea that the future is unpredictable. It seems like an obvious statement, but there are far too many investment philosophies out there that seem to focus on the idea that we have some ability to forecast the future. We are humble in the sense that we admit that we cannot and will not try to forecast what's going to come. So that once you admit that you can't forecast the future, it gives you the freedom to take a little bit of a more open-minded and broader approach to the investments that you're selecting. And largely that comes down to the belief that there is no one best investment, no best one strategy, no best investment style. It's some combination of all of these things that is ultimately going to give us the best results for our clients. Further to that, we are very collaborative in our approach. We believe deeply in our philosophy that having multiple people, multiple experienced people, multiple educated people, multiple people that are really focused on this investment aspect of the business is going to help us come to better results for our clients than any one of us could individually. Bias is inherent in every human being, everybody with an emotion anyway, which I think is all of us. And having multiple people on the team with different backgrounds, different experiences, different tendencies, different personalities is going to help smooth out some of those biases that exist. Because if I have a bias for one thing, somebody else may have a bias that tilts a little bit in the other direction. And by taking a collaborative approach, one where we debate any of our investment ideas and their merits, it's going to help us address some of each other's biases and, again, remove them from investment decision making. So taking our philosophy for what it is, there's really three key principles that come into every investment decision that we make. And if you go back to our philosophy, I think it'll be very clear why these principles exist. The first, and I think foremost, is diversification. Diversification is hugely important to everything that we do, because again, if you accept the premise that we don't know what's going to happen in the future, then we can't pick the one specific thing, the one specific investment that's going to deliver on that best outcome. So we need to have a variety of different investments that cover a variety of different styles, strategies, investment types, geographies, asset classes, because that's going to give us the best and most resilient portfolio to get to that unknown future. The second one is downside protection. We want to protect our clients' hard-earned money. That doesn't mean we're never going to lose money. That doesn't mean you're never going to see a down month or a down year. I guarantee that you will. It doesn't mean that we'll never have a mistake along the way. What it does mean is that every decision is made with building the most resilient portfolio possible, one that is going to avoid blowing up, because that's the name of the game. The name of the game is staying in the game to receive the success that compounding will instill on your portfolio. And importantly, avoid those significant mistakes that will materially derail your future plans. The third principle that I would highlight is one that I call robustness. And robustness, what I mean by that is that it has to be, when we're implementing an investment decision, it has to be something that has some validity, some proof, some theory, and some evidence to support it as an investment idea. There are a lot of flash in the pan type of investment ideas that come and go. That is not what we want. We want something that is rooted with a long history of consistent results, ones that we can see and have a real belief and tangible evidence that it should persist into the future. And better than just seeing good results historically is also some logic, some rationale, some theory to support the idea, to support why it works. If you're mirroring theory and practice and you're getting the same consistent results from both of those things, then that's going to lead to robust investment decisions. if I had to broadly separate all of these things into two categories, they come to two very different approaches. One is to just go out in the world and to bump into all kinds of different things. Kind of like bumper cars, you're in this little pen, you're bumping into all kinds of different ideas and seeing which ones stick, seeing which ones have some merit. And then when you do identify those ideas, you chase them down. The second approach is to look very specifically for what you want to accomplish with the portfolio. Sometimes you have a specific need. And when you have a specific need, you do a specific search. And that can be very targeted based on the criteria that we look for that specific investment to try to identify the best one to fill that hole. We have recently, over the past year, identified that one of the mutual funds that we invest in, the active mutual funds, has had a lot of turnover in their investment personnel recently. And these are key personnel, people that are responsible for the decision-making at the firm as it relates to the investment portfolio. And not only as it relates to the investment portfolio, but for the direction of the firm as a whole. This is something, although this investment has been quite a good performer over the years, it's something that gives us a little bit of discomfort. It's part of our ongoing due diligence process to continually evaluate every investment that we have in the portfolio. So here we see a specific need to replace this investment, to look for something that is in the same category, the same type of bucket that we think is going to deliver us good results, just like the last investment that we've had, but one that we can feel more comfortable about the structure and the ownership and the decision-making going forward. It's all kinds of factors and data, and it's really dependent on the type of investment or type of decision that we are analyzing. For an individual stock, for example, we're going to do deep fundamental research on that company and its industry, including things like, where do we project the growth of that industry to go? Do we expect prices to increase or decrease in that industry? Do we expect volumes to grow? Then it relates to that company in the sense that, do we expect that company to grow its share of revenue or its market share for the business? Do we expect that company then to grow its revenue? We can look at all kinds of things related to that specific company as it relates to its balance sheet, its income statement, its cash flow. We're projecting not only the growth of its revenue, but the growth of its margins and the growth of its margins and its capital intensity, its need for capital. All of these things will ultimately get us to what we think is a reasonable target for that company. As it relates to a mutual fund, and I'll just broadly refer to all types of funds where it's a basket of investments, we'll look at a different set of criteria. We'll look at what we call our 5 Ps. 5 Ps stand for process, people, product, portfolio, and performance. And just so you know, performance is specifically designed to be the last of those 5 Ps because it's the last thing that we look at and maybe the least important of the 5. Process relates to how they make investment decisions. People relates to the investment personnel that they have making decisions there. Product are things like costs, how the product is structured, does it make sense for what we want to accomplish for our clients. Portfolio is how the outcome, what the output is actually from all of those things. How does it manifest itself into an actual investment for the client? And lastly, performance is quite self-explanatory. How has that investment performed in the past? And lastly, I'll mention the macroeconomic and bigger picture view that we take of the world when making investment decisions. And we have some key indicators that we look at that we think are, maybe you can foreshadow a little bit as to what can happen in the future. And this will help guide us with our asset allocation decisions. Do we tilt one way into the wind or maybe the other way, a little bit away from the wind? Performance is fleeting. It will come and go. It is very dependent on, again, a world that is unpredictable. So there could be something that performs very, very well most of the time, but doesn't perform well all of the time. And if you're in that period of underperformance, if we want to call it that, that doesn't mean it's a bad investment. It just means that it hasn't done great for the last little while. It could be a fantastic investment going forward, but historically or in the recent past hasn't done so well for a wide variety of reasons. This is why the disclaimer is on every investment product pitch that's out there. Past performance is not indicative of future results. There are all kinds of things that can happen in the world that will influence performance, and that doesn't necessarily tell you what's going to happen going forward. Performance can be influenced by things that exist in the world that have nothing to do with the merit of the individual investment that you're looking at. Just the same way that an athlete, one of the best athletes in the world, can go through a stretch of time where they're not scoring points or not performing up to their standards. There could be all kinds of reasons for that. And that doesn't necessarily mean they're a bad player or no longer should be a professional. It just means that they're going through this period of time where it hasn't been up to their expectations. Recently, we have purchased an individual stock for our client portfolios called Verecan Tower. This is a stock that we started researching over a year ago. It came to us through what we would call a screen. So looking for any kind of stock really with specific criteria, things that we find are often predictors of a stock that might be of interest to us. And we did the research over a year ago, and we did an in-depth dive on the stock at the time and identified it as a company that we thought had some good growth potential, but it was at a price where we didn't quite want to purchase it yet. We didn't see enough upside for our investors. And when you're setting prices for individual stocks, it's always a bit of a ballpark estimate. You don't know exactly what price the stock should be. So you try to make conservative estimates and you try to give yourself enough margin of error. So even if you're a little bit off with your target price, you're still going to get satisfactory outcomes for your clients for the investment. And we sat on this investment for just about a year, sat on our watch list. We monitored it on a regular basis and held off until it reached that price, that target where we thought there is now sufficient upside for us. The market is showing us the things that we want to see from it. The timing is right to purchase this investment because, again, we do see the potential for it that is sufficient and gives us enough margin of safety that we're comfortable dipping our toes in. I would be pretty confident to say that no investment goes into our portfolios without dozens of hours of thought, research, and debate. And some it's several dozen, and others it might just be one dozen. But there's a lot of time and effort and thought that goes into any investment decision. Typically, we're starting with a high-level overview on both a qualitative and quantitative basis of any investment that we're looking at. That could be relying on our data sources that we have to pull information, doing analysis and calculating ratios, and looking at the factors and qualities of this investment that we find are most pertinent to it as an investment approach, to it as a potential investment. From there, we're often doing, I guess, what we would call boots on the ground research, even though boots are often virtual these days. And we will try to do an actual interview with the manager or company or individuals that represent this company or this potential investment opportunity. And that's often eye-opening because when we do that, we're trying to challenge our original thoughts or our original thesis or answer any questions that we have remaining after that initial qualitative and quantitative analysis. From there, once we decide that an investment decision could be a potential addition to our portfolio, we bring it to our investment committee. Our investment committee is a group of like-minded but different individuals on our team that meet every week. and we debate the merits of any investment that goes into our portfolio. And when we're looking at this portfolio on a weekly basis, or meeting on a weekly basis, we are looking at what's happening in the world, what's happening in our client portfolios, and deciding if we need to make any changes to reconcile those two. So if an investment decision, a potential investment, gets discussed at that meeting, there is still much debate to be had about whether it can fit in the portfolio. And ultimately, if it does, then we can move on to the execution phase and implementation. There's a lot of overlap between those two concepts. The Verecan organization is going to decide on the best investments in a specific category. The client's risk profile will determine which percentage of those best investments they should receive, because the different investments will have different risk and return objectives. So, for example, a client that's 30 and has 30 years to go until they need their money is going to have a very different risk profile and set of objectives than our 85-year-old client that requires money to put food on the table on a monthly basis. Ultimately, they're probably going to have a lot of the same investments. The younger client will just have a lot more, a larger percentage of the growth-focused investments, and the 85-year-old client will have a greater percentage of the income or safety or stability-focused investments. If it's the best investment in a category, every client should have it. It should just be a different percentage of their portfolio. Step one would be idea generation. And this is actually identifying the potential investment idea for inclusion in the portfolio. And as we talked about before, there's a wide variety of different ways that we'll go about that. But bottom line is we're always looking for interesting investment ideas, ones that can be additive to our portfolio. Step two would be to do our due diligence. This is all the detailed qualitative and quantitative analysis that we feel that is needed to completely vet this investment idea as a potential addition to the portfolio. Step three, I would say, is to consider how this investment idea can fit within our portfolio, because not every good investment idea is necessarily a good fit for what we're trying to accomplish. As an example, if you already have a pickup truck, there's probably not much sense in having a second pickup truck. You can only drive one pickup truck at a time. And lastly, the implementation phase, we would bring any investment idea that we think fits well within the portfolio and that is value add over time to our investment committee to debate its merits, to further challenge the idea that it should be a part of the portfolio. And once that they get that final stamp of approval from the investment committee, then we can move on to execution and actually putting it into the portfolio as a part. Interesting to us is something that has a track record, a demonstrated track record of adding value, and that we can properly model for having a potential to add value in the future. And this differentiates an interesting investment idea for us from what many in the media or popular culture might think is an interesting investment idea. Interesting in the mainstream often relates to a flavor of the day type investment, what's interesting in the moment, what is doing very well right now. Often the best performing investment is the most interesting investment, which is totally contrary to how we think about the world. So we take a much more reserved approach and a much more disciplined and a much more academic approach to our assessment of interesting. It's hard to pick out a couple criteria that are going to be crucial in all instances, but if I have to pick some overarching themes, it's one that it has to be value add. There has to be some ability for this investment to add value, and it could add value in a number of different ways. But broadly speaking, that's either going to be through improving the growth profile or improving the risk profile of our portfolio. The second part is that's absolutely crucial for any investment idea is that it needs to fit well within the portfolio. You are not going to buy a second pickup truck if you already have a pickup truck. You can only drive one pickup truck at a time. So we don't need to duplicate something that is already represented in the portfolio. All we need to do is select the best of those two. That's just one example of how something can fit in a portfolio, but similar to it being value add on an individual basis, it should also be value add on a portfolio basis. We evaluate investment performance on both an individual and an aggregate basis. Every individual investment that goes into our portfolio has an appropriate benchmark assigned to it. And we're consistently comparing that investment to that benchmark to see if it's outperforming or underperforming. Secondly, we will compare to a relevant benchmark at an aggregate level. And that means combining the stocks that we select and seeing if they're value add versus relevant benchmarks. We will look at the equity side, the stock side in aggregate of our portfolio and compare it to a relevant equity benchmark. And we will do similarly on the bond side of the portfolio. And then at a very large scale bird's eye view level, we'll look at our balanced portfolio or our interaction between the stock and the bond part of our portfolio and see again if we're adding value versus a relevant benchmark. Every decision, every benchmark is chosen to give us some insights into how that investment is performing, but also how we're making investment decisions. How effective are we at making those investment decisions, and are our investment decisions adding value over time? It's not going to be a knee-jerk reaction to something that's underperforming or outperforming. If something is underperforming, there could be very valid reasons for its underperformance. It could just not be the right environment. Maybe something very specific happened to lead to its underperformance. When something is not performing as expected, we look to then understand, why is it not performing as expected? Is it a reason that we think is just transitory? It's a temporary underperformance for reasons that we can understand and explain? Or is it something that's going to be more permanent? If it's something that is going to be more permanent, then obviously that's our inclination to make a change. But often it's not clear. When something underperforms, we want to understand why it's underperformed. If we can understand why it's underperformed and are comfortable with that explanation, then often we'll keep holding it. If something has underperformed and we can't understand why it's underperformed, often that's a reason for us to move on from that investment. And similarly, if something has underperformed and we know exactly why it's underperformed and it's something that we don't like, that we didn't expect to happen, then that's another reason why we may move on from the investment. So performance is a good guide. It's not an absolute. It doesn't tell you exactly what to do. It usually tells you just that you need to dig deeper and try to understand more. Outperformance may or may not tell you anything about how an investment has done. In the same way that underperformance can be explained, if you can understand outperformance and something is outperforming for valid and understandable reasons, then that's great. That's actually exactly what you want from an investment, is one that is outperforming for reasons that you can understand. There are times when something outperforms and you still are not exactly clear why, or it's outperformed and it's unexpected. It's not what you wouldn't have expected something to outperform in that type of environment. And interestingly, both of these reasons are, again, create an impetus for potentially looking to move on from an investment. I think ultimately you want to understand an investment and understand the types of markets and types of environments it's going to perform well in and not perform well in, because then you can build a properly structured portfolio. If you choose an investment and you can't understand when and what environments it's going to outperform or underperform in, then that means that you should maybe be looking at something else as a piece of the portfolio. If it's not immediately apparent why something has outperformed or underperformed, then we go back to our initial steps of our investment process. We go back to our qualitative and quantitative analysis. We go back to our deep dive, trying to meet with the company or meet with the organization that manages that fund, and ask all the hard questions that are not immediately apparent. We're essentially reverse engineering perhaps the investment process to try to get to the root cause of what we're seeing.